What's the pass percentage?
I think it's
Seems like it's above 84, so it has to be 90.
I read it as
a 90.
Yeah, I read it as 96, 97%, but it could be. That's only what I read in there. Yes.
No, but that can't be because Stella got 90.
Okay.
Yeah.
Well, I'm gonna wait until we see what incorrect answers we've got. I haven't got the time.
You're a steward. You're a TEA steward. That's why they let you slide, Stella.
No, but I think
It's difficult to improve. Also, you know.
Yeah.
I mean, I've read through all the material multiple times and watched the podcast and still don't understand. So, not for lack of trying.
Mhm. Mhm. Yeah. Mhm.
Yeah. Hi. So I'm Eric. I'm from Hamburg, Germany. I'm in crypto since a couple of years, and I never really went into the technical and economic and engineering parts of tokens. And I'm happy to go the second or the next level in my blockchain and token education.
Yeah. What about Vulcan? Vulcan is new, no? Or has he been?
Yeah. Hello. Hello. I'm Volkan. I'm 24. I joined from Turkey, Turkey, Antalya. I have been in blockchain for 6 months or 7 by now. I'm trying to discover new DAOs and the ecosystem, and I just wanted to go deep into technical stuff with token engineering. That's why I'm here. It's great to be here with you. Thank you.
Okay, that's great. What's your background, by the way?
What?
What's your background?
My background is a little bit design, a little bit motion design. I do
Wow.
motion design and advertising and marketing stuff for companies.
Oh, that's nice. Yeah.
Thank you.
Hi, Roro. Hi, Stella.
Hello. Oh, nice to see you. Yeah. Very funny. Yeah. Hmm. So, can I highlight that there's a spelling error on the fourth line? Okay, that's it. That's my
Eh,
contribution.
I have a question. Is there a reason that we skipped the ethics part?
No, we did that earlier.
Did
We
we?
did that
Oh, I
on the
might have missed it. I
second.
apologize.
Yeah, because we've done the module one and section 1 and 5 together during one of the earlier sessions. So we'd covered it way before the other
All right,
stuff.
gotcha.
Yeah.
Gotcha. Okay, apologies.
Yeah. Yeah, it's on the Notion page. You'll be able to see it. Yeah. 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 Yeah.
Gotcha. Thank you. Sorry about that.
No problem. Mhm. Okay, I think I'll take this. Yeah. So, hi guys, I'm Rohan. I mean, for the newcomers. Basically, the way I thought about structuring this at least was that I thought that we can go through the building blocks of the concepts before we actually go into what AMMs are. So, I can go through like 3 of the definitions that I think are pretty important to understand before we can even understand markets and then automated market makers. We can briefly speak about the history of financial markets also on one slide, and I think we'll move on to AMM proper. So basically, there are 3 key concepts that I found while I was searching around that I thought were very important to understand. I hope my voice is clear, by the way. Am I audible? Yeah. Okay. So the 3 concepts that I thought were important were one of them was market liquidity, which keeps on coming up. And it basically describes the trading capacity of a financial market. the availability of assets there, and it depends on liquidity providers. So the thing that's important to know is that it heavily depends on liquidity providers, and they are the people who allow others to trade on the assets and they earn a fee on for that service. Another very important concept is price discovery, and that is the result of interactions between buyers and sellers. So, in the sense that we don't know what an asset is actually worth, because it's actually worth what people are willing to buy it at the end of the day. So the way price discovery happens is like the buyers and sellers in the market, they come together, they battle it out in some sense. They put out their intent to buy or sell, and you end up figuring out at what price the market is willing to buy it at. And that generally is called price discovery. It's very important to know that price discovery and market liquidity are quite heavily tied together. And the third point was market fragmentation. This was something that I would want someone else to help me understand better. But because I understand it in the normal markets, I don't understand it as well in the financial markets from what I understand. That market fragmentation, from what I understood, was that it's the trading activity is divided in different pools. So let's imagine there's a lot of trading activity happening in one city, some other city, or let's say it's happening in different pools online, on the chain, where the liquidity is not being efficiently distributed, and therefore, since liquidity is low in every place, therefore you're not able to conduct as much commerce as you would have been able to, is what I understood from. It makes the market inefficient is what I got out. Can we move to the next one? I'll tie this together to market. So basically, with these three concepts, you can kind of start understanding how financial markets actually evolved over time. Like initially, you have models such as request for quote, where if you have, let's say, a stock or some kind of asset that you want to sell, you would go around asking people how much they are willing to buy it for. You get a bunch of different quotes, and then you decide what's the best one that you can go with. Invitation for bid is almost the same format, where before markets exist, you kind of have to just find a peer that's willing to buy it from you. And that's, again, extremely inefficient. You might not get the best price for the thing. Price discovery is hard, and liquidity is hard to find. That's when flow trading comes in. And flow trading, you must have seen the pictures of people yelling and screaming and huge high traffic environments in closed doors, where basically what's happening is people come with their buy and sell orders. They try to find a peer that wants to buy or sell it at. Eventually you move from there to having brokers who would do it for you. But at the end of the day, it's the same thing is happening. You're struggling to find another peer that wants to buy it from you at a particular price that you're willing to sell it at. And most of these, we can go back. The last one is still left. Oh, you're jumping around. Okay, you got it. Okay. So flow trading has its own inefficiencies in that sense. That's when the CLOB model comes in, which is centralized limit order book. And that's basically the model that New York Stock Exchange, FTX, Coinbase, it's still widely used everywhere. The main concept here is that it's a centralized body that instead of you finding a peer to sell the order or the asset to, you end up going to the centralized body and you give them your order request. So at what price are you willing to buy it at? How much are you wanting to buy how much and at what cost are you willing to buy something at? You send those buy and sell orders to the centralized body. They connect the buyers and sellers by themselves, and then that's how the process is done. It's it's way more efficient than any other model, simply because now you for the first time have an order book, which is an entire database of all the buy and sell orders that have gone through, and price discovery is easier. It's transparent for everybody. You can in some sense see what the previous history of the prices have been, and therefore know whether you want to buy or sell it, and therefore you end up opening up more liquidity, you open up more trading activity. As people trust the system more, it's transparent. Next one we can go to. So that's when AMMs kind of come in. Like these concepts really help me understand why AMM was such a relatively revolutionary thing. Basically, initially, if you're on chain and you want to trade your assets, again, like if you don't want to do it through a centralized body, you're kind of stuck with actually finding someone who's willing to buy or sell the asset to you. So again, request for quote or invitation for bid is the main structure you would do it through. But AMMs come in, which around 2017, 2018, where like the concept is that there are liquidity providers who will pool in their assets in one place. And people who want to immediately buy or sell something, they don't need to find a peer in the market to do it too. They can actually just go to the market maker. They go to the smart contract, which already has liquidity available at all times. But at the cost of a small fee. That fee is in order to get the service of being able to trade something quickly and efficiently or seamlessly, you're willing to pay that fee, and that fee goes to the liquidity provider. So that's quite a smart concept. The brilliancy of it comes around like when we think about the fact that it's happening decentralized, it's happening autonomously, and majorly it's happening without audible. That's really relevant because the way you price discovery becomes extremely complicated if you don't have an order book that has a history of buy or sell or something like that, which is readily available. And you could do that, but the main point is that in order to do it without a centralized fashion, you have a bonding curve, and a bonding curve would be something like a constant product market maker, which is what we are learning with the thing that Uniswap came up with. I not came up with, but at least they implemented it. The original paper on that, at least, it was popularized by Vitalik in 2017. And that's also a very interesting paper, the article, by the way. I'll link it on the chat. It's called On Path Independence. And the thing about that is like now you don't have to find a peer. You can actually trade through a contract. Liquidity kind of is always available, and that basically does the service of a cloud, which centralized services used to. You needed centralized services before. Can we go to the next one, Stella? Where do platform fees come in? If there are no platform fees, how do they profit? Would there be a micro? Wait, I thought there's always a fee, right? Like, am I wrong about this? Because there would always be a swap fee that most of these market makers would take. Because you have to provide something to the liquidity providers. Yeah, Ratio, go on.
The reason I brought it up.
There are 4 fee tiers on Uniswap, right? So from 0.1% to 1%, depending on the actual ratio of assets. That's pretty much same with Balancer or SushiSwap or anything else.
I just brought it up.
Go ahead.
I'm wondering how much it plays into the model of these systems because, for instance, where I think it's Intro to Complex Systems Study Group, they're doing an AMM model, but the platform is not included in this model. So that was my question about that. That's why I asked. Thank you.
No, there must be some other mechanism to incentivize liquidity providers then, because why would they otherwise provide that service? But I might be wrong. Like
they earn fees. They earn fees. There are 4 fee tiers. Am I audible?
Yeah.
Yeah, there are 4 fee tiers. Otherwise, you suffer. There's no way to avoid impermanent loss, right? There's opportunity cost of putting it on an AMM, since you're not going to participate in the gains of your asset anymore. That went the way of Luna. So you can't participate. It's kind of the same thing. It's just that you inflate something to overcome the impermanent loss. What what you have to realize is that this works well if there's no trending in the markets and it's mean reverting. You actually make a profit without any fees. But if if it's trending in one direction or the other, you actually lose money. Not directly, you would still have your assets, but you would lose the gains that you would get.
I'll be
So
back in
platform
one.
fees are mandatory. Yeah, platform fees are mandatory. Otherwise, you don't. There's no way to overcome the loss.
Yeah, I mean, even in the Vitalik's paper, like in 2017, I think he mentions Banco's protocol, and Uniswap came a year after that. So you're right about that. Mm-hmm. Also, Stella. Hmm. No, I was saying you can also go through the Excel sheet that we had because I think that's a very interesting way to explain slippage when we get there. The easy one. Yeah. There's a lot of sound behind me, but yeah, okay. So there's liquidity rewards, protocol tokens, and security rewards. That are the three type of rewards that we have here. Liquidity providers locking up their funds in pools. Actually, Stella, can you take this? I have to go. Like someone's calling. I'm really sorry. There's some people who come right now. I have to open the door. Yeah, please. Yeah.
Oh, it's usually, I think
Deepak,
it's
do you have
usually
something?
split. Sorry, I think it's usually split between the platform and the liquidity providers. For example, you have to pay 3% doing a swap, and out of the 3% of the sum, let's say 50% goes to the protocol and 50% of that fee goes directly to the liquidity providers.
Sure, sure. So basically, yeah, the implicit costs were broken down into slippage, impermanent loss, and security risk. So slippage is something I think we will get into properly. We have a Excel sheet to show like some of the properties that we were discovering yesterday. And so slippage basically it's difference between the trader's requested price and the actual price that ends up executing. Traders prefer less of it. I mean, they didn't go too much in depth, at least in the course that we were going through. Like traders prefer less of it, and smaller trades will have less of it. The basic structure of it is that the way you imagine it is you're on a bonding curve, and if you make a big trade, you end up moving. We'll just show. Actually, we'll just have to show you the Excel sheet to actually see it. Impermanent loss is basically it's basically when you have you're a liquidity provider. You put like your assets on the pool, and when the market moves. In fact, actually, this would be something someone else can get into properly, because this is something I also want to understand more in depth. So if someone wants to like unmute their mic and explain like impermanent loss, that would be great. Rohan, maybe? Yeah.
Yeah, so you can think of being a liquidity provider as selling straddle if you've traded options. So when you trade options, you're essentially betting. If you buy an option, you're kind of betting on volatility. When you sell an option, you're betting against it. Of course, it's more complicated. You can hedge out what is known as the Vega risks, the volatility risk. But in the AMM space, it's kind of you're selling volatility to traders, and you're hoping that the price mean reverts, right? So every time it moves, you would be losing. So you would have to pay out the trader. Like if the price is more volatile, you end up okay. So let me step back. Let me give a more concrete example. Let's say you have ETH and BTC. So if ETH and BTC, so you would be earning one or the other, right? So if someone wants to exchange, put Bitcoin into the pool and take Ethereum from the pool, while Ethereum is going up, you lose any gains that you would have had holding Ethereum, right? But you would gain more Bitcoin, and maybe Bitcoin's not doing anything, and vice versa. When Bitcoin's going up, you're earning Ethereum. So if you actually take the net position in the end, you might have earned more by just having the ETH and BTC in your wallet.
Like just holding it without actually putting it in the pool. Yeah, okay.
Without putting it in the pool. If you don't earn fees, but let's say you earn fees, that makes up the difference. Right. Sometimes if your pool is very actively traded.
Yeah. Kojak, do you want to step in? You'll have to unmute him, right?
Yeah, can I take a stab at liquidity loss?
Yeah, hi Chris.
Yeah. So can I share my screen to explain this liquidity loss thing?
Yeah, sure.
Okay.
Will you have to stop sharing, Stella, or how does it work? Okay, everyone will have to switch to Chris's screen.
Can you see my screen?
Yeah.
Yeah. So I just want to type something. There's two things. So with liquidity loss, first of all, you have to understand what Rohan and Stella have explained with how AMM works. So as a liquidity provider, we are mostly staking two tokens. So let's say our tokens are token A and token B. And at the time of staking, let's say you stake at the price of $10 for token A and token B. So let's say the total amount of token that has been staked in each pool are 10 of token A and 5 of token B. So the value of each of these tokens is $100 each. Then the pool value will be a function of these two values. So let's just assume that. But for simplicity's sake, let's just assume that it's 100 by 100, which is 1,000, 10,000. Sorry. So how liquidity works is every liquidity provider on the pool has like a pro rata share of the total liquidity.
It's not 100.
Hello?
It's not 100 times 100.
Yeah, I'm not giving the exact formula. I'm just using something to go by. That's it. Just some tentative. Can I go on?
Yeah.
Yeah. So if you provided say 2% of 2% of sorry, if you take 2% of the pool, which would be in this case, or let's say 10% of the pool, which would be in this case, one of token A and two of token B. You own 10% of whatever the total sum of this liquidity pool is. So whenever you want to withdraw your liquidity, you're going to get back 10% of whatever the value, or whatever the total value of the pool is, or depending on your pro rata share at the time of stake, because your percent might change as more people staked. But the idea here is that when price changes, the liquidity pool has to keep this value constant. So it will adjust its price and its quantity per se, to get this value to be constant. So let's say the price of token A rises to 20. Then now, to keep this value constant, the quantity of, and this drops, let's say this drops to, or let's say it doesn't drop, let's say it stays at 20. To keep this value constant, the liquidity pool will have to sell some of this token. Sorry, I'm trying to do the math quick mentally here. So it will have to rebalance the concentration of this token to maintain 100. So this will become 5. Sorry. So this will become 5, and this then becomes sorry, but then so I'm not good with this mental math that much. So the idea here is this will rebalance the quantity will rebalance to have different tokens, but keeping this constant.
Keeping the constant,
just to reflect the right price. So as a liquidity provider, if you want to withdraw your token at this point, your 10% will no longer be your 2 token A, your 1 token A and 2 token B. You will get a different quantity, but the dollar value of what you staked will be the same. So now, so the liquidity loss check here is, if you had held your token without taking it, the value accrual from the normal price movement would it have been higher than you receiving the new balance. So let's say your new balance is 0.5 now, 0.5 and say 4. So these two might give you the same thing in dollar, but because of how much price has pumped with each one of these tokens, you might have missed out on some possible gains by just holding the token. So where the fee comes in is it tries to make up for the possible loss or like opportunity cost of holding of providing liquidity. So that's my understanding of liquidity loss.
Okay, thank you so much. Yeah. Kojak, are you saying something? I couldn't hear you.
Yeah. Can you hear me?
Yeah.
Yeah. Okay. Now, I think both Rohan and the previous speaker, they've actually. Oh God.
Yes.
They've actually explained quite a bit. What I do is that I'll prepare a separate note and I'll post it on the group, because what I'll be saying will be even longer. So let's just continue, man.
Okay.
Yeah.
Okay. We can, Stella, do we want to go through the slippage? Is this the right time? Okay. Okay.
But
You'll have to share your screen again.
Is it possible to? Is there any way by which these chats are retained somewhere? I mean, when we go through the recordings, because some of them, especially the last one, there was so much content in the chats. It would have been useful to get access to.
The links were saved on Notion. Ratio had actually saved all the links.
You can also always come back to this channel and check the chat. Chat is also it's auto saves.
Is the chat? I mean, is there any way? Okay. Anyway, continue. Yeah.
Yeah. Yeah. Yeah. That's a lot. That's a lot. Yeah. But at least the important stuff we should be taking it. I'll try my best to do. Yeah. Yeah. Okay, perfect. So security risks, I mean, yeah, it's just as simple as everything on the internet is hackable. Like these automated market makers are pretty new in the system. Like we still don't know what the loopholes, the attack vectors completely are. Different models are coming in constantly. Things are broken like all the time. So basically anything on the internet. Koja, can you mute a mic? Someone say. Yeah. Yeah. So basically, things are new. Don't take more risks than you're willing to, and that's 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 the basic like takeaway from that one. Yeah, do you want to go into slippage now? Like we can share the screen. Yeah. Yeah. Here I can explain at least what I understood from here, and I found it very mathematically. Huh? Can you hear me? Oh. Oh. Yeah. Okay. No. I don't think we need the formula. I think we can start with the idea that okay, let's say block zero. Like I mean, when we are starting out making a new pool, and it's a constant product market maker. We started with let's say 1 ETH and 12 BNT. So what that I mean, with the assumption that both of their dollar values are the same, in the sense that 1 ETH is worth 12 BNT right now. So you put it into the AMM, and when you multiply them, you get a constant product which is 12. So this 12 we are going to keep constant now. That's the rule that we are sticking. The reason we are doing that is the constant product has interesting properties that we actually need, which is that when a lot of people want ETH, the price of ETH will go up because I mean you'll see that when we do this here. So dy by dx also I'll explain in the next one. So basically in the next block, let's say you look at 1 ETH for 12 BNT and you're like, hey, that's amazing. That's a great when I go outside, that's not the price I'm getting. So I want to give my 1 ETH and get 12 BNT in return. That's what you're expecting because that's the dollar value are the same in theory. But the problem is when you put the second ETH in, since the constant product needs to be 12, you'll divide 12 by 2 because the total ETH amount in the pool will be 2. When you divide that, you get 6. So BNT needs to be 6 in order for the product to stay 12. So what happens is when you put 1 ETH in, you get 6 BNT out. In order to the constant product will always stay 12. So in that process, you end up getting 6 BNT out, not 12, right? So that's kind of basically you're building up towards understanding what slippage is here, which is that you expected 12 for every 1 ETH you expected 12 BNT, but you're getting 6 out. The reason because when you put the second ETH in, the constant product didn't. In order to keep the constant product same, the amount of BNT that comes out is lesser than what you expect. And okay, Stella, if you want to take, maybe if I'm not explaining this well enough, you can take this. But yeah, the price of at any point when you actually draw the curve itself, which is supposed to be a hyperbola, because when you multiply y and x, you end up getting that shape on a curve. When you try to keep the k constant, the slope at that point is the price at the end of the day. And as you're buying more ETH, you end up moving on the bonding curve, and the slope changes at the end while doing it. So you can't, as you participate in the market changes itself. Is the main thing that we need to understand. Stella, do you want to take this back? I guess I'm not explaining it as well. Mm-hmm. Mm-hmm. Yeah. Yeah, Price impact was a very important point, I think, too, right? Hmm. Yeah. Mhm. No, also, was BNT being minted at the same time? Was the total volume that's a very big point too. Right. Mhm. Okay. Okay, that's interesting.
I think, yeah, so I think it's easier explaining slippage as a function rather than a bug. So we all know price as a function of demand and supply, right? But the thing with slippage is, how else would price move in response to supply or demand if not for slippage? So if you're a trader and you're trying to buy 1 million worth of an asset in a market depth of 10 million, it's expected that you to push the market. So the price you buy as your order begins to fill from, let's say, the 10,000 to the 20,000 up to your 1 million, it keeps increasing it like incrementally as the more assets you accumulate. So naturally, you don't expect to get like the same price by the time all your order is filled from compared to when you start. So rather than seeing simply slippage as a problem or a bug, it's more of a function. It's a market function. So it's just a natural occurrence in market. And I think it's part of why oracles are kind of a problem in the market today. So like they don't respond to those kind of DEX or derivative markets that use oracles. It's kind of difficult to respond to those kind of market situations. So it creates a room for exploitation and stuff like that.
Right. Wait, there's something on the chat. What is the time frame we are looking at for slippage? So this is something that even I got confused with. I thought slippage had something to do with front running. I thought that the reason the expected price isn't the same as the actual price gets executed is because maybe people are front running and maybe the market is switching before your actual order is executed. But that's not the case. Like slippage is something you can actually pretty much predict if you're within a pool. You know that if I'm buying one, then what the difference between the price right now is to the price that'll be after my trade is done. And generally, the actual slippage will be the geometry between the price, the initial and the final price. But it's again something you'll have to like read into because I'm not able to explain. We need some visual.
One way of thinking about this is your AMMs are extremely dumb market makers. Right? They don't have a lot of information about the price. They depend on external participants to adjust the ratios to bring some information on the price. Right? So if there is someone who is extremely informed, like they know that the price on Binance is say $12 or something like that, and they decide to bring. Hello?
Yeah, we can hear.
They know the price is $12 on Binance, but on your DEX it's $6. So they can literally wipe out your liquidity pool trying to adjust that price. So they can buy out at $6 and sell. So it's a very toxic form of arbitrage. So slippage is essentially protections against that. So if you want to buy large amounts, you need to forego large amounts of the price. You will get much worse price. That is by design. So the DEXs or AMMs are meant for like small noise trades, as opposed to someone who wants to do $10 million swaps or something like that.
That makes sense. Like the two things that they also mentioned were like for smaller trades. For there's another point that slippage, like you want less of it in smaller trades.
And plus, one huge advantage was seen in the Solana stoppages, right? When Solana kind of paused the blockchain, they have order book market makers on Solana, and so they got much worse prices than the AMM styles, right? So because the AMM styles adjusted to that stoppage, and they just picked up from where they left off because of path independence, whereas central limit order books depend on the orders that you put previously, right? So in order, there's a correct ordering for central limit order books that don't exist on AMMs.
Yeah, ratio, like none of these use oracles from, at least the constant product ones, etc. don't use oracle from what I understand.
I had a question here. I think great point brought up by Rohan. Um, is when it compared to the order book based markets and to the liquidity pool based markets, so what would be a good, a comparison? Like one of the things Rohan just mentioned. So can we somebody if is more knowledgeable can just put down the main points which like a pros and cons between that would be very nice to understand.
Yeah. Yeah, anyone can go ahead.
Order book markets are usually not a good idea on blockchains. One, because they are dependent on the order in which you can, because that if you have to move to the top of the book in order to get your order filled, there will be a lot more competition for that price, for that place. Whereas for an AMM, this is not the case. But the
Also,
disadvantage
massive computation is another thing. Like order books will require a lot of computation to constantly figure out who to match.
Yeah, well, you can do the computation off chain and then submit a proof that the computation was done correctly. So that's not as big a problem these days. The major problem is the ordering, which if there is for any reason the contract needs to be paused or something happens, it's obviously you can't maintain the ordering anymore.
So how do centralized exchanges manage this issue, like ordering issue?
For them, there's no. Yeah, they control the ordering, right? They have different order types.
And usually, I mean, if I understand it right, they use like first in, first out kind of systems, along with the price at which you say you want to buy it, or like the price range.
Yeah.
And why can't you do first in, first out here in an automated market?
It's expensive.
I would think, expensive to do the computation. Also, front running becomes a massive issue here. I don't know if that...
and there's a very competitive fee market, right? With this, because if your order, the point at which your order gets filled is dependent on how much you're willing to pay in fees. So whatever you see on the MEV side on Ethereum or any of these blockchains get replicated on Uniswap, internal to Uniswap. That's usually a bad sign because it raises the externalities for all the traders. So everyone has to pay a much higher fee because you're essentially when you place a trade, you're taking away from someone. It's a zero-sum game, right? So someone is getting a worse deal, kind of. When you have a lot more information, you can use that information much more efficiently in order book AMM than constant product AMM.
Also, another thing about you can find most of this information. At least I learned a lot from the Vitalik's article, which was written back in 2017. But this, I'll just send it on the. I learned it's a little like mathy, but it really goes into like everything I needed to know to understand. Right. Right. No, that's where like people would change the bonding curves. You talk about all these other things, but I think what Rohan meant when he said like the AMMs are dumb is that they don't know anything about the external, right? Like they are stuck on this bonding curve, and people have to come and arbitrage to actually settle the prices. Yeah. Mm. Mm. Yeah. Yeah.
Former node validator. Yes, well, 10 years in this space will do that to you. But um, yeah, you know what? Like I was listening to everything and very, very great conversation. I think from my perspective about the AMMs is that there was I think something was brought up with respect to how do centralized exchanges do it better or something like that. And just in the back of my mind, I'll just share this. In the back of my mind, the one thing that I thought of is in centralized exchanges, the order book approach. It also allows for more. This is my view. I could be wrong, right? But I believe that it allows for more market manipulation in that space. Now, with AMMs, there is forms of manipulation that occur, but due to this sort of balancing act between the arbitrageurs and the AMM, you are able to find a better equilibrium, right? But when you have more of an order book, I find that I've been part of the GameStop. I was in Wall Street Bets for like since 2015, and like what happened there when the exchanges shut down, like that sort of stuff, like I'm not saying that it doesn't happen in AMMs, right? But those centralized order books, I feel that they have their own fundamental flaws. So at the end of the day, I think we're only going to get better from here with AMMs. I think there's only room for improvement here. So that's the only thing I was just going to share. But yeah, the conversation was really great so far. Did I meet up to your standards, Stella? Good. Okay. Thank you.
No, but we just wanted to hear your voice.
Thank you. Sorry I was late today.
Anyone else? Florin, do you have anything? Yeah. That's a hyperbole.
Yeah.
Like it's a conic section. So if you take a cone and cut it in a particular angle, you get like this curve. And it has very interesting properties. I mean, yeah.
Yeah, I think it's the same thing that Roro posted. It's just a different way of looking at a similar equation. And this is like the most simple one. I think this is the one that Uniswap uses, where it's just like X times Y equals K, I think is what it is. And I think it's the same. It's a visual showing the representation of the same thing. It's just explained a little bit differently, a little bit like less mathy, maybe.
Yeah.
Yeah.
I mean,
This is like the most.
it's also actually showing slippage, like what the.
Yeah.
Hmm.
Yeah.
Oh, yeah, I will. Hmm.
Definitely the last thing. I had a full of questions, and so since this is my second session, and I'm still trying to other sessions I missed, I have huge difficulties to get a better picture of the economic dynamics, especially behind it. My background is healthcare and science. Never dealt with economics before or finance. Have been into crypto since 2017, but still this is so new to me. And yeah, I actually don't know where to start to ask. And I think what would really help is a sparring partner. And in fact, I know someone, he's also located in Berlin. We wanted to do the course together, and I think we definitely should sit together and just talk and get through some examples. Yeah, but very overwhelming.
Yeah, no, that's understandable because at least today was quite a leap, like in terms of the math that we're doing, because last modules didn't have anything like that. But I would say that the thing that helped me the most was there were YouTube channels like Whiteboard Crypto, Finematic. These channels really do a very beautiful job of explaining things visually. They go through all of these concepts pretty thoroughly and very, I mean, so with a lot of, yeah. Oh, it's just my, yeah.
Oh, I keep on, yeah, I keep on learning, and exactly will stick to the program. I do have some questions about the exams, so because you were discussing assignments last week. I found the PDF, and you showed the PDF as well, and we will have exams at the end of the year, or this is the second module, so yeah.
Yeah. And also, you can give the exam anytime. There's no, you don't have to wait at the end of the year or anything. Like, all exams are open. If you study the module, you can start giving. Yeah. 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 And I
There's
would
no
suggest like
deadline.
go through the material, and every time you're stuck, you should. Yeah. Okay. Yeah. Most of them are very open. No, I was just guiding. I was just saying that anytime you are stuck at like go through the module. Every time you're stuck at a concept, watch a YouTube video. Is how I do it. Like that's how I've learned most of these concepts. Yeah. Yeah. Hmm. Yeah, and also I think there are no silly questions in the sense that if you ask a question, I think we all will learn a lot from the links and the articles that other people will provide. So please ask all your questions here. It would be great.
I sorry. I apologies. Thank you for we should change the name to Brave Learners Group because we're brave in learning new things. I will share one thing that I was questioning, and I was gonna maybe ask the group. Looking at the AMMs and the sort of the balancing act of the AMM with arbitrageurs. I was just curious if anybody came across this particular, came across what is the sort of ratio of manual arbitrageurs versus automated arbitrageurs in an AMM. I was curious about that. I didn't come across any of that information. So I was just curious if anybody knew that off the top of their head or they'd done that research. Yes, correct. Versus somebody taking and going to a CEX, a centralized exchange, and doing the arbitrage manual. I was just curious.
I would assume that the way you could figure that out also is that you just look at how differently the assets are priced in different pools. If the rate at which they're like adjusting is very quick, or the price is always very close, it's probably because even a slight change, some bots in and arbitrage is what I would assume.
Yeah, that makes sense. That would make sense. Yes. So there's less. Yeah. So there'd be less. Sorry. Go ahead.
Oh, yeah. Actually, I've done the research for a project I'm working on. Close to 80 to 90% of the swaps are done by bots. It depends on how you identify the bots, right? But it's very easy to identify them on Ethereum because they don't have the code hash. Externally owned accounts don't have a code hash associated with them. So if you go by that, 80 to 90% of the activity on most AMMs are bots.
So Rohan, did you do that research by Sorry, did you do that research by actually doing an ether scan on the certain proportion?
No. We run full nodes ourselves and we get the full state. because it's important for our own project to know how much of it is, let's say, contract or MEV bot activity versus human activity, right? Or a manual activity. Some pools like ETH BTC on Uniswap are almost entirely bots. 99% are bots. There are other pools that, there are other pools like, I don't know, Ohm Butterfly, for example, is 99% bots. And ETH USDC is close to 85% bots. And the interesting thing is most of the human trades or manual trades are very small trades. So are the bots, because they don't want to suffer the slippage. But the bots trade so much more that most of the fees on Uniswap is generated by these bots.
But I would assume, why would any place have 85%? Why would it not always outcompete the humans back to 99? Like, wouldn't it?
Because it's not a competition, right? So AMMs, at least the kind of AMMs we are talking about, humans don't really lose if they just keep their sizes small enough. So you're not trading against other humans, you're trading against the LPs.
Right.
So it's not immediately visible. So that's why the impermanent loss issue becomes very significant.
Yeah.
Can I ask a follow-up, Rohan? So to their research, which ecosystems had a higher MEV?
Anything related to Ohm. Most
Ohm?
of them are MEV bots. Yeah.
Okay. Thank you. Thank you for
Also,
that.
we are very close to the timer. So we explain the homework too, right? So it's a whole module. And ask all your questions on the chat. We are always open to answering.
I can't share it right now. We might write a paper sometime in January, because we're still going through. Well, it's part of a much larger research project. So we might end up publishing that later.
That's also in June, right? Rohan, is that something that can be queried out in June?
No, you can't query it out in Dune. You have to run your own full node.
Okay.
First, you need to identify what is likely to be a bot, which is actually a non-trivial problem, right? An easy way of doing it is just see if it's the swap has been initiated by a contract or by a human, because the contract can do much faster than humans, right? So that is an easy way of just identifying bots in general. So MEV bots are much harder to identify because they can, even though the blockchain is public, they engage in some of these MEV bots I don't think are coded up by a human being. Like I was discussing this with Trent last week as well. Some of them seem to be generated by, I don't know, evolutionary programming or something like that, because they're really weird in the way they use liquidity across at least Ethereum. So and they provide most of the transactions on Ethereum as well.
But what do you mean by weird? Like, I mean, how would you?
I mean,
say
one obviously they don't open source their code, right? So they don't put the SPDX tag on top, or they don't identify themselves as a contract. So all you have is the bytecode, and when you decompile the bytecode back to Solidity, it uses patterns that no actual Solidity programmer would use, right? It's really weird.
Oh, that's okay. Thank you so much, Rohan. Like, this was a lot of. Oh, that's a great link. Okay, guys. Thanks for the discussion, everyone, and for the session. Yeah. Hello.
Thank you. Bye bye.
Thanks.
Bye, everyone. Have a good one.